All right, welcome everybody to this week's Middle Class Investor. This is Seth Martin, your host, and today we are going to be looking at the financial markets as we normally do. And let me pull up the S&P 500. And generally speaking, it was an up week. It was a pretty decent week given how tight the range has been. But we are getting very, very, very close to the market resolving itself one way or the other. And I'm going to read just a few things here in a minute, just a few factoids for you to prepare you for the possibility that the move that it's going to launch, the direction it's going to launch in, will be down. And I'm imploring that you prepare yourselves and people you know and your family members to prepare yourselves for what is, I feel, is imminently near. So anyway, let's zoom in on the S&P 500 and just look at it. I took the drawn items off because mine's very busy. I've been adding a lot of things to it, so I've taken the drawn items off. But in general, we've been looking at, the markets in this essentially a trading range. Really since way back here. I mean, it's kind of a trading range. Now, depending on where you draw this trading range, I mean, we could be above it, or you could draw the range bigger. But essentially, we're in this trading range. And one of the things I have drawn on here that I can't remember, I don't think I've had in the past. See this shadowed area in the middle? This is called a Bollinger Band. And the way the Bollinger Band works is roughly 98%. This is a 2 standard deviation Bollinger Band. So roughly 98% of all price action, in this case it's over a 20 period average, so it's a 20 period moving average, is contained within this Bollinger Band. And you can see from time to time, price, when it gets outside the Bollinger Band, usually that's a good place to, in this case, while we're talking about that, let's just look at it. In this particular case right here, this is potentially a good place to go long anytime you get way outside the Bollinger Band. Of course, in hindsight, that proved to be a good place. So the Bollinger Bands can be useful in times of market extremes. But as what you see here is we don't have any really market extremes. We've had this really tight range, and it's been like that for a long time. And I've talked really since about 2011 on a weekly. Now, if you go to a daily, if we look at the last year, you can see that we get outside the Bollinger Band much more often, because now it's a 20-day moving average. And so, but anyway, the one of the challenges, and I've talked about this before, for traders who make up most of, and I'm talking about professional traders, make up market activity. Because this gets tighter and tighter, it becomes very, 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 very difficult for traders to make money, or more difficult, not very difficult, but more difficult than it otherwise would be. And so what tends to happen is, slowly but surely they decide to sit on their hands one at a time. And as enough people sit on their hands, then volume dries up, liquidity dries up, things like that, and the market tends to fall under its own weight. And it looks to me, just kind of a cursory look, looks to me like that's what has been happening. Let's look at volatility, because we generally look at volatility right after we look at the S&P 500. And real quick, I'm just going to put the studies back on. Whoops, not the studies, the drawn items. So you can see what we've drawn here in the past. And we had this green line for the longest time, and then we switched to this blue line. And now the blue line is getting leaned upon and breached. So I don't know, we might have to end up drawing another line. And this is a whole another discussion around technical analysis. markets tend to revert to the mean or to a trend, a dominating trend line, and that's why people who use technical analysis draw trend lines. But you can see we got to the upper the upper range of this descending channel that we drew here, and that just tells me that this market doesn't have much more to go. We might come down maybe to this middle area and close a couple times, but as soon as we bust out of this downtrend line, you're probably going to see an expansion of volatility, which means the market's probably going to sell off, and panic will ensue, as they say. So anyway, let's go back. Let's look at some of our some of the things we normally look at. Let's look at the interest rate. We've been talking about this theme for a long time, and it's one of the main reasons I wanted to start this video blog, is because the bond market, this is really where the bubble resides. You could say stocks too, but the bond market is that's the dog that wags the stock market tail. It's much larger in size. It's much more global in nature. There's vast amounts of money involved in these bond markets, and it's potentially catastrophic what is setting up here, and that's why, again, that's one of the main reasons I created this video blog, is to inform people of the risks. So just so you know, this little move right here from this move right here, let me draw it on here. I'm going to try to demonstrate how punishing this can be to your money. This little move from here to here, if you had bond funds, probably cost you 10% of your. Let's say you had $100,000 in bond funds, you probably lost $10,000 in this move right here. That's how significant this could be. Now, bonds are pulling back, and we can talk a little bit about that. We've talked about this like large white candle or large black candle before, about being support. In fact, we talked about it right back here where we had a large white candle, and this is a technical analysis kind of tenet. When you have a large white candle or a large black candle like you have right here, the midpoint tends to be support. Now, it's not always that way, doesn't have to be that way. It's just a good place for us to look for a potential support location. And in this case, it worked out great. Now, going back to this large white candle right here, we can see that we're basically at that midpoint right now, maybe slightly lower from here. And I don't know. Anytime you're talking about support and resistance, you're really talking about kind of a range. You're not so much talking about an exact point on the chart, because it's just too many people involved, where there's too much variance in people's opinions to have exact locations. So you could see this penetrate this large white candle a little further, just like these days did. You can see how these days in here kind of went further down. You could have a day like that. You could have some, say next week, let's say it gaps down to about here and runs down. Maybe it runs down to there, but then at the end of the day it sells off, or it comes back, and essentially what you end up having is just a little tail that penetrated this zone. And then, of course, all likelihood, then the market would be off to the races. And we've talked about this. Steve Griffiths likes to call it an important high or an important low. So I've got this important low marked over here. Let me zoom in on it. This, I'm saying, was an important low in the bond market. This is where, or in yields, bond market, it's an important high in the bond market. Let's call it that. And so yields were 1.396. I'm sorry, the low yield was 1.394. So that's pretty low. And Steve Griffiths talks about this technique a lot. If this is the first move, and he stresses if, and I'm stressing if here. So if this is the first move off an important low, okay, and this pullback that we've been witnessing for the last year and a half is the first pullback, then this could be what's called in Elliott wave terms a third wave. In fact, it's likely a third wave. So starting from here. So third waves are the longest waves. They tend to be the most powerful. They tend to be where the most fear is. In fact, I can go back and show you kind of a famous third wave, if you'll bear with me here. So right in here, I'm not gonna zoom in too much because sometimes zooming in a lot makes it even harder to see. But this is a third wave right in here. This back in the financial crisis. You had a wave one, you had a pullback, and then you had kind of smaller degrees of ones, twos, and threes and everything, and then you had this large degree third wave. So actually, you know what? I'm in the bond market. Let me show you in the equity market because it's a little easier to see. So you can kind of see right here this whole thing. Let me zoom in a little bit. Not too much because I want you to be able to see it. It's hard to see. So this would, in this particular case, this would have been kind of your wave one down to here. This would have been your wave two. And all this would have been wave three. Now, there was times when it moved up and, you know, sure, that provided some relief. And then here's your four and here's your five. So, you know, a lot of people talk, you know, there's a big debate in the financial community, and I'm not here to solve it, about whether Elliott wave is real or socionomics is real or whatever. But the markets do seem to move, at least in these larger degree trends, like Elliott said they moved in. So you can see here, 1, 2, 3, 4, 5. So and the reason the 1, 2, 3, 4, 5 in Elliott is what they call the impulsive wave. It's the wave of the larger degree trend. So that's why it's important to try to realize relatively early on, do I have, and if you analyze this closely, you would see that this is 5 waves. And maybe the 5th wave was extended or something like that. But if you were to analyze this closely, you would find that this first wave over here was 5 waves. Just like if you go over to the bond market, let's go back to the interest rate market. In the very same way that you would have found this to be 5 waves. And so what the theory actually says is once you identify 5 waves in a large enough degree of trend, that then becomes the dominant trend. And so now here's where let me just disclose where the uncertainty is. Is this 5 waves? You know, the bottom line is it's open to interpretation, right? Somebody could, I mean, it doesn't look like what I just showed you in the equity market in 2008. It looks different. So there are some people that say this is 5 waves, and there are some people that say it's not. And that's why there's a market. That's why there's some people that are bullish and some people that are bearish. I think a prudent way to think about it is, though, what's more likely to happen? Are interest rates? Let's pull up a very long chart of interest rates. This has been the trend direction for the last 35 years. You can see from we were at 16 back here in 81. Interest rates on the 10-year Treasury were 16%, and now they're at 2.2%. So, you know, you can kind of see with this expanded view, if you look at all these highs where they penetrated and fell through, they penetrated this moving average. This one really looked like it was going to be it, right? But then it fell and penetrated and fell through. Well, now we're so low, right? This is such a low point. And I know in Germany rates have gone negative, and some people think the rates are going to go negative here. But it almost looks like if you look at this carefully, it looks more like, you know, a 1, a 2, a 3, a 4, and a 5. And there's really nowhere else on here. If you look anywhere else on here, you're not going to see this same pattern. So in Elliott terms, he says the trend in yields is up. And all we're experiencing here since, let's see when this was, I don't even know off the top of my head, but all we're experiencing since this date, the week of July 2nd, 2012, this was all in the direction of trend, and then since January 2nd of 2014, this has all been counter trend. This has all been, you know, bearish in a larger bull market, if you will. Or if you're thinking in terms of bonds, this has been bullish in a larger bear market. So this is, again, I'm going to say it again, this is one of the main reasons I wanted to create this video blog. I think there's a huge amount of risk in this market. There's a tremendous amount of money in what they call the high yield market. The United States government has been borrowing a lot of money, and massive deflationary periods come after large amounts of money have been borrowed, and credit. If you think about it, if we're living on borrowed money, and then credit becomes tighter in the future, what happens to that lifestyle that we were living on that borrowed money? Well, it goes away. Well, and since it goes away, you have a deflationary kind of situation that sets up, and it's probably going to be pretty long. I mean, there'll be times when the market is moving up, and but the longer term, maybe generational type of trend is in a deflationary direction. I know that's pretty tough for some people to hear, and you've heard it your whole life. The market always goes up, but I can show you a time when it didn't go straight up, and let me just show you that real quick. We're in the S&P 500, so let's just look at all data, and let's go back to this time frame right here. This is September 3rd, 1929. Okay, and you can see here 1, 2, 3, and I don't know where 4 is, somewhere in here maybe. Maybe this is 4. I had a little 4. But I'm going to measure this real quick, and I'm just going to show you from right here to right there was 86% drop in equity value, and it lasted 1,002 days. So that's almost 3 years, right? And sure, there was some, maybe there was no prosperity there in that period of time. And supposedly, you know, the depression didn't end until the late 30s. So really, this whole time from here to here, this was very deflationary. You know, banks weren't lending, and it was just a tough time for the mass population of people in the United States and around the world. And really the bigger bad news on all this is it tends to lead to war. So that's the part we really all need to be aware of, and make sure that we don't allow our politicians to, you know, basically get us into a war based on economic problems at home. So looking at the euro is showing some strength. the question is, just like we, and I don't know the answer, but the question is this a bull rally inside of a bear market that's going to go like this? Go like this, or is this a move up? And just the reality of markets. Once you have a big sell-off, there has to be some bullishness and some buying that comes back, because there's a lot of value at these areas, and traders perceive that. And so it's in a zone that we would expect the market to go to. So, and I've talked a little bit about this before, but if you kind of look at this big move here, whoops, you can kind of see this big move here, right? And then you've kind of got this move up to here. And this move up to here looks kind of like a triangle, like this. And a lot of times, the markets, this is probably like a wave 4, a lot of times the markets will pull back into this triangle area, which they have. Now, certainly I would not buy the euro here. If you're wanting to get long the euro, I would wait, because the reality is, if it is bullish, it's going to turn right in this area. I drew the wrong kind of line. I apologize. It's going to turn. In other words, our resistance is right here. So you don't have much more way to go. In fact, if the euro gets into this zone right here, I think it's more likely that you'll see the euro pull back to at least there, and possibly all the way back into this area. We've been talking about parity for a long time. A lot of people think that's where the euro is going, so it wouldn't surprise me. There might be, we'll talk about the dollar in a minute, but if you have a big bond sell-off and a big stock market correction, you might see more money moving into the dollar as kind of a quote-unquote safety trade, and as a result, the euro may fall to parity with the dollar. You can see here that Germany is sitting on the trend line in a very precarious kind of location, but it's not a bad location to enter, especially if we can get a candle that looks like, not that, but looks like, let's say next week you kind of have something that looks like this, where the close is above this area right here. If you can get a close above this area, then you can enter. Now you might want to enter on a pullback, but in other words, if we can get a close above this area, then what we'd expect to happen is the market to meander its way up into this resistance area that we had marked on the chart up here. So if you're looking to go long the DAX or something like that, I would wait for it to get to close above this candle here. Hopefully that answers your question. If anybody over there in Europe is watching and wants more clarification on that, feel free to write in the blog or comment on the blog, and I will write you back and we can discuss it further. This is Japan. We've been expecting Japan to move up into this resistance area, which is likely to do over the next several weeks, maybe month. It might take a month for it to get up there. I don't know. That's part of the unknown. It's part of what we don't know about financial markets. The UK broke its trend line a while back and has been chopping its way higher. It's already reached, with this, you can kind of see this counter trend move here, which, I don't know when I put this on here, but I put it on a while back and said this is likely where the UK is going to go. But anytime you have this counter trend looking move where you have overlapping action, this is probably some sort of ABC. And ABC is another Elliott wave notation, but most of the time after an ABC, you get a 1, 2, 3, 4, 5. So this could very well be 1, 2, and now we're going to have a 3 down to here, and a 4, and then a 5. So my gut feeling is that the next move down in the UK has already started, and I would expect the UK to move down into this area here, and over the next, I don't know, 6-8 months, maybe. I don't know if it'll take that long. Might only take 3 months, but certainly if you're looking to go long the UK, I would not do that just yet. I would wait till it got into this support area marked by this blue box. We looked at volatility. I talked last week about the divergence that's happening in the equity markets versus the transports, and that's an old Dow theory signal that quite a few people still look at and place a lot of emphasis on. So anytime the way it kind of goes is anytime you have typically the transports and the larger index would move together, and anytime they don't move together for some substantial period of time, that is what's called a divergence, and it usually leads to some sort of trend change. It could be a trend change in the upward direction if the divergence is positive, and it could lead to a trend change in the negative direction if the divergence is negative. And currently the divergence is negative. Transports are way down, and Dow's trying to make new highs. So we did, I don't have it up here, but the comp Q, I can put it up here, which is the NASDAQ, reached its all-time high this past week. If we go back and look, you can see here, you can barely see it, but if I kind of hover over this mark here, the high is 5,132.50 at the peak of the dot-com bubble. That's what was that again? That was the high was 51.32, and the high over here this week was 51.43. So we've regained everything that was lost in the dot-com bubble, and it only took 15 years. And actually, if you did some analysis and said, well, U.S. dollars isn't real money, gold really, let's say, is real money, and you divide by gold, we would not even be halfway to the dot-com peak. So real purchasing power is today only about 50% of what it was in 2000. And I know that seems almost unbelievable, but it really is the case. You can also use the PPI, the Producer Price Index. I wouldn't use the Consumer Price Index because it's highly manipulated by the government for I guess political reasons. I'm not sure why they manipulate that, and so they don't have to raise Social Security payments to retirees and old people. But anyway, that's that. Again, I think there's probably another move left in the dollar. Let me pull it up here real quick. Let's look at you can see on a short-term basis, we may have already, let's just talk about a short-term basis. This right here, what you're looking at, this long tail, this is called a hammer. And it's a candlestick pattern that is very common at the end of a downtrend, or it could be an inverted hammer at the or sometimes a shooting star if the body's down here at the top of an uptrend. But a hammer occurs at the bottom of a downtrend, and generally speaking, once you break out above the hammer, then that's supposed to be the end of that trend move. And now it could pull back and retest this line again. Not really a line, but maybe let's say more of a zone. So we could come back and test this zone above the hammer, but the dollar is looking like, to me, in the short term, this is on a short-term basis, looks like, and this is only hourly, so you can't place a whole lot of emphasis on that. We can look at a daily and see if we see a hammer. Well, in fact, we do see a hammer on a daily, but it's not a confirmed hammer yet because it hasn't closed above the high of the high day of the hammer. So once we get a closing bar above this high. So let's say next week, for example, we get something that looks like this, then you could, with a high degree of probability, say that the downtrend in the dollar is now over, and that the likely direction of the market is now the dollar up. Okay, so we'll look at that again next week just to kind of see where things are. But to me, the dollar, I've had this on here for a long time. The dollar is well on its way to 101, 102, or will be soon. And you can kind of see here, there's like an A, B, C, and then there's just one move up. This could be a 2, and the next move could be a 3. And maybe 101 is not even enough. Maybe the dollar is going to go much higher than that. But I think the run down in the dollar is probably over or nearly so. And you could look at gold and probably see that. If the dollar starts to move up appreciably, and this is kind of a conflict between the dollar and gold. To me, it looks like gold's going to kind of move up into this area and then pull back. But I don't know. I mean, theoretically, the dollar and gold move in opposite directions. So, this whole downtrend of gold is because dollars are somehow becoming more valuable. Seems weird, but that's kind of what it means. We haven't looked at oil. Let me look at oil real quick. We've had this wave 4 up here for a while, and I don't know. To me, the market looks kind of weak. I mean, I'm not sure we're actually going to make it up there without pulling back a little bit first. This could be some sort of corrective move here. I certainly wouldn't enter oil long just yet, because this could be some sort of corrective move here, and then you might see something like this, and then the oil makes its way up into this area. But it looks like oil, to me, at this point, wants to pull back first before coming to this wave 4 area that we've been talking about. So I don't know that I would enter long oil just yet here. You could, and then say if it gets below here, you're out. But to me, it looks more bearish at this moment than bullish. That could be wrong, but that's just what I see. The DAX, we talked a little bit about Germany already. My Ninja Trader here has identified, the end of a trend change, in this case, which is the end of an ABC, and it looks like it's wanting to not really predict, that's not the right word, but calling for, the DAX to at least move into this 12,105 area, which could be a counter trend move, right? This could be the first move down, and this could be a counter trend, and then we've got a big wave 3 coming in the DAX. But for now, you could actually go long the DAX with a stop just below this 10,797 area, and that's a pretty low risk, high reward, low risk return. I don't want to look at that. Let me go back. I'm going to go back and look at something on the S&P 500 that I want to show you guys real quick. Not so much in the price action, but let's get back on a weekly. Basically, since when is this? Yeah, since about November of 2013, you can see this trend line. That this is the RSI, and it stands for relative strength indicator, and it kind of gives you some of the internals, momentum, things like, it's an oscillator. Okay, so oscillators, kind of tricky. They tell you when market's overbought, oversold, things like that. But it's a lagging indicator, okay? So it looks at price in the rearview mirror, so you really can't use it. You can kind of use it to tell you the general direction, but it's not a great timing tool. Now, there's people out there that will disagree with me, but bottom line is, since November of 2013, we've seen this general decline in momentum in the market. So think of it as like the underpinnings of the market are getting weaker and weaker and weaker. Now, this is also known as a divergence, okay? Because when you have this internal structure of the market getting weaker, but you have the price action itself going higher, this sets up a divergence, and the divergence is such that the momentum indicator is telling the truth and price action is not. So what this divergence is telling us is that potentially the market is severely overbought and is in for a correction, and it could be sizable given the length of time. I mean, you don't typically see divergences develop over this period of time. I mean, you might see them develop over months, but usually not years. And potentially, if we go back and look at monthlies, and it could be longer than this even. But I think this is very relevant time frame for what we're doing in this video blog. So anyway, that is really. Well, it's not all I have. I want to read a few things because there's a lot of dissension, it sounds like to me, in the market about whether we're in the middle of a bull market or, the beginning of a bear market or, whatever. I mean, there's just opinions galore, right? And I just want to read a few things. This is from the Elliott Wave Theorist this month, and there's just a few facts here that are interesting and I think noteworthy. In 2000, the total dollar-denominated debt that existed in the world. Okay, so total dollars in debt. That includes consumers, you and me. That includes government. That includes all state and local government. It doesn't include things like Social Security. Okay, it includes those are more like IOUs. These are real debt obligations owed to a bank, a person, another government. Okay, so these are kind of like our debt, our national debt. Okay, plus state and local debt and consumer debt. So in 2009, total dollar-denominated debt was $52.7 trillion. And at the end of the first quarter of this year, the total dollar-denominated debt was $9 trillion. So in a little over 5 years, about 5 years. So or 6 years. In 6 years, we added roughly $7 trillion in debt. And, some of that's consumer, government. There's a lot of bad actors there, but that's how large the credit has expanded. And I don't know if you recall, but in 2007, the reason we had a problem, the big reason we had a problem, was it was a credit crisis, right? Banks weren't loaning to each other. People were defaulting on mortgages. And so what this tells me is that none of that has improved. In fact, it's gotten worse. And so that's probably not a good sign. Margin debt is at an all-time high as its percentage relative to cash and available margin. So what is margin debt? Well, margin debt is like if I have a brokerage account and I'm 100% invested and I want to go buy, more stocks and I don't want to sell any of the ones I have to take on what's called margin. So effectively what I'm doing is I'm borrowing money to buy stocks. And this is one of the things that exacerbates selling when you have a market sell-off, you have a market correction. People have to sell stocks in order to pay off their margin. They got to pay off their loans because think of it as their house value is going down. They got to raise some money to get out of their house. And this causes more selling, which then causes even more selling, and so on and so forth. So margin debt is at an all-time high relative to the amount of cash in those brokerages, and not just brokerages, but also mutual funds, the people that manage your money, they either hold very small amounts of cash or they hold no cash and trade on margin. And then another factoid here. Let's see. This one's going to be a few sentences. The Dow's annual dividend payout. So I don't know if you know this or not. The Dow Jones, like if you trade the Dow Jones ETF, every month there's a dividend. And so if you owned the DIA, for example, which is the Dow Jones Industrial Average, every month you would get a dividend according to how many shares you own. So that's what this is talking about, the dividend associated with the Dow Jones Industrial Average. The Dow's annual dividend payout has been less than 3% for 235 out of the past 246 months, or 96% of the time since January 1995. Over 20 years ago. So for the last 20 years, the Dow has not been that profitable, I mean, relative to the past. Prior to this, the longest duration, under 3%, was just 1 month. So prior to 1995, so something changed in 1995 is basically what this is saying. And prior to 1995, the Dow never had dividends less than 3%, more than 1 month in duration. And for the last 20 years, we've had 235 out of 246 months have been below 3% in dividends. So the reason this is important is part of the reason your stock rises is because of, well, mainly because of dividend, but also because of people buying. The demand for the stock is going up. People trading up for the stock and things like that. But the only real reason to do that would be to make more money on the dividend. But as the stock goes higher, the dividend as a percentage of the stock is drawn down. So what this is saying is that basically since 1995, which is about when all the Fed craziness really started, you can maybe say it started a little earlier than that, but maybe that's where it kind of started manifesting itself with the Federal Reserve really, being, interest rates. They were kind of well on their way to lowering interest rates for the long haul, Anyway, I just thought that was an interesting factoid. Let's see. The stock market rose 6 straight years on declining volume. So that means fewer and fewer participants are driving the market higher and higher. That's usually a liquidity problem. It has been trading on especially low volume since 2012. Such a thing has never occurred before. 1 year, maybe, but not 6. Declining volume during an advance is usually a sign of a bear market rally. Let's see. On May 20th, the Dow Jones Transports closed at a new 6-month low on the very same day that the S&P 500 index registered an all-time intraday high. This is that Dow theory divergence that we were talking about. And there's only like a handful of times or maybe that's never happened. Let's see. Well, it just says the degree of this divergence between these two indices is unprecedented. So here's another one. The percentage of bears among stock market advisors, tallied weekly by Investors Intelligence, is at a 38-year low. The last time the measure was lower was in early 1977. So, basically right before a big bear market. But that's an interesting number. That, despite hearing some people on TV, giving caution, the vast majority of participants in the market are very, 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 very bullish. And this is usually when you get this extreme. We've talked about the analogy of a boat and everybody getting on one side of the boat flips over and everybody falls in the water. That's kind of what happens when everybody's on one side of the market. The boat flips over. Let's see. How about this factoid? According to the Wall Street Journal, May 25th of this year. In 1999, U.S. government guaranteed 45% of all financial debt. Today, it guarantees 60% of all financial debt. That's what some people are calling the government bubble. Not to mention, some of these obligations that we have out in the future. So, just be careful and try not to get too crazy. Let me show you one last chart. This is a guy I follow. His name is Deneric. If you're interested in these Elliott waves, let me not zoom in because that's not really helping any. He's saying that this was wave one. He shows this tightening, of this triangle or this rising wedge that we've been talking about, and you can see he's into the last set of waves here. So you got a one, and this is kind of the fractal nature here. You got this one here, but then you got a 1, 2, 1, 2, 3, 4, 5 which we haven't completed yet, which will make up this 3. And then we're going to have another little sell-off about halfway down through this channel. And then he's saying we'll peak out over the top of this upper trend line, and then I'll be the end of it. And the way these resolve themselves, these rising wedges, is they go back to the start. And the start is not actually on the chart here. We've talked about the mid-1800s. This market's selling off pretty violently toward the mid-1800 area on the S&P 500. He's not showing a chart of the S&P 500 here. This is the the Wilshire 5000 because there's just more stocks in it. That's what he does. But anyway, I just thought that was interesting. I kind of check on his blog every now and then and look at his charts. He's a pretty good chartist. He does a good job. He's if you want to check him out, it's Deneric's Elliott Waves. Anyway, that's it, y'all. This is the middle class investor here. Tell your friends and family about it. There's just a ton of risk out there. I know it's very difficult to time market, but I just showed you a chart that will help you understand a little bit better about where the potential turn is. Put it back up there again just for grins and giggles. There it is. So we're talking about an expected turn around the first part of July, which is oddly enough, that's right when the June 30th Greek payment is due. I don't know if you've heard about that, but there's a lot of talk about the June 30th Greek payment. I mean, that may be when this thing sells off, and that may be the catalyst that kind of gets this whole thing going. I've talked about it before. I don't know that there's any real contagion there, but the financial markets, that's one of the things that Elliott Wave and socioeconomics is built on. It. The financial markets are not rational all the time. They go through periods of time where they're very irrational, and so you can't rely just because you don't own any Greek bonds or the U.S. government doesn't own any Greek bonds. There's kind of an irrational feeling that nobody really knows who owns them, and so let's take our money out and sit on the sidelines and wait and see what happens. I mean, that's kind of the irrational part of the market. And there's nothing you can do about it except either live through the sell-off or pull your money out and sit on the sidelines and wait till things clear. So you don't have to believe, quote unquote, like a religion in Elliott Wave. You just have to understand that the financial markets are not necessarily it's not the way prices move in your grocery store. It's not the same kind of effect. It's a more irrational kind of marketplace. So don't get caught up in, the value of this and the value of that. It doesn't really matter what the value is. The only value that really matters is if you're going to be a buyer of a stock at X price, it only matters if the value only matters if somebody's willing to pay X plus something. That's the only thing you really care about. and people have opinions all over the map about what that value is. So don't get too hung up on that. I know a lot of people do, and therefore they can't believe that the market's down 80%. Just don't get hung up on that. It's not the same thing as an economic market, like your grocery store, or the price of cars, or even the price of houses are more rational than the price of stocks, mainly because you need a house. It's part of it's part of your value system. I need a house to live in. I need shelter. And I'm not going to overpay for shelter. I'm going to pay the market price for shelter. Just like you're going to pay the market price for food. Why would anybody bid up the price of bread? I mean, the only reason for prices of bread to go up is if there was not enough bread. But that's not the same way the stock market works. So anyway, enough of that. I've talked for a long time today. I'm just feeling like the timing we're getting closer and closer to a point where, we're going to have to make a decision. And some of us won't want to make one, and that's fine. But my fear is you're going to lose 15, 16, 17% before you even have an opportunity to make that decision, because this is going to be a pretty violent move, and there's not going to be much you can do about it. So to the extent that you want to live through that, that's fine. If you want to take some money off the table here, or maybe wait and watch Deneric's charting and wait for it to get a little higher and then take some money off the table, I think that's fine. But I think it's fine to take money off the table here as well. All right, everybody. Well, thanks a lot for tuning into the Middle Class Investor. As always, I appreciate you coming in. My hope is that you'll tell other people about it. You don't have to come in and watch every week, but it's probably good to come in every now and then and see what we're talking about. Probably while there's nothing going on in the market, maybe next week I'll talk about technical analysis, because it's been a long time since I've talked about that. And it's an important part of what I'm doing here and how I do it. And I want to make sure that those that are interested understand how that works. So until next week, you guys have a good one, and take care. And happy Father's Day to all the fathers out there. Bye-bye, everybody.